Welcome to the FMLS Market Intel Report. I'm Leslie Appleton Young, Chief Economist for FMLS. Uncertainty continues to drive market perceptions, and the most recent economic data have been mixed. But the economy is also better overall than expected just a few short months ago. The CPI for June saw the largest monthly change since January, bringing it to an annual increase of 2.7%. This jump from May's 2.4% was expected as tariff effects start to filter into consumer prices. This also gives the Fed support, although opinions are divided, to delay any rate cuts when they meet at the end of this month. Whether tariffs continue to drive increases in inflation will bear watching. As for employment, in June, the economy added a greater than expected 147,000 new jobs, dropping the unemployment rate to 4.1%. Good news, despite some signs of potential weakness, such as increased difficulty for new college grads to find their first job. Retail sales have whipsawed this year in expectation of tariffs and higher prices for consumer goods. May saw the largest monthly decline since January, in part a pullback from the large surge in spending in March, where consumers spent ahead to mute the impact of higher prices. The May drop is more of a normalization, especially in big-ticket items like autos, gas, and home goods. The Federal Reserve Open Market Committee met in mid-June and kept rates unchanged, the fourth consecutive hold since last December. The wait and learn more stance remains in place as the Fed monitors tariffs-related inflation, uncertainty, and labor trends. Going forward, roughly half of the FOMC expects 2 cuts by the end of the year, while the rest are leaning toward no cuts at all in 2025. Markets generally expect 1 to 3 rate cuts throughout the remainder of 2025, with the first likely in September. The University of Michigan's Consumer Sentiment Index saw a noticeable jump in June as consumers registered a sigh of relief. After widespread concern over tariffs and policy volatility, consumers calmed down in June as tariff pressures receded. While recent history drives perceptions, going forward, the 30% tariffs on imports from the EU and Mexico set for August 1st may impact this rosier outlook. Mortgage rates continue to fluctuate within a fairly narrow band, in part driven by the hotter than expected jobs report, as well as tariff uncertainty. Rates ticked up on July 17th to 6.72%, the second week of higher rates after 5 weeks of decline. Note that rates are still down 14 basis points since the end of May, and analysts see rates trending down over the next year, but not by much. Averaging the forecast from Fannie Mae, the Mortgage Bankers Association, and Wells Fargo gives us a gradual decline to 6.43% for the second quarter of 2026. In short, the odds of returning to a below 6% rate environment in the next year are slim to none. Selma Hepp, chief economist at Totality, summed it up nicely. The prospect of elevated mortgage rates throughout 2025 suggests that housing market activity will continue to be challenged. It is the reality of elevated rates more than any other factor that is driving the revised and more subdued forecasts for home sales and prices. Nationally, home sales are expected to be slightly above 2024's 4.067 million, but not by much. At the same time, the average forecast for home prices this year is for a modest gain of 1.9%. What should you do? My recommendation is to counsel clients on how to navigate market conditions today, rather than wait for a market that may not happen. Take a look at market intel on the FMLS website to access the most current market statistics. They are updated weekly. If you're interested in resources relative to our market dynamics and want to dive into local markets, we've got you covered. For FMLS Market Intel, this is Leslie Appleton Young. See you next time.